But background is in economics. I'm a professor at UConn. Started there a year ago, and so this is my second year. I got a PhD in agricultural economics from UC Davis. Finished that up 3 years ago, and then I was working for the USDA Economic Research Service in DC for 2 years, and that was a really dynamic place. Lots of really smart people there. It's a good place to continue my education before I joined UConn. My background, well, my research interests are mainly in the areas of food and ag policy. So that's a bit about who I am. But today we're going to be talking about risk management, mainly crop insurance, and then...
Is the clicker working?
I don't know. I haven't tried it yet.
Oh.
Yeah.
Oh, okay.
Yeah, thanks. So crop insurance is going to be about the next 30, 45 minutes, and then I'm going to talk about some tools similar to benchmarking, maybe complementary for evaluating new business directions. And you've got all the slides in front of you. So for the first presentation, I'm going to give you a very brief overview of the Farm Bill, which provides the funding for the Department of Agriculture. And then we're going to talk about crop insurance in generally, and then the individual crop insurance programs that are available in Connecticut. So this is a graphic from my former employer, the USDA's Economic Research Service, and it shows the funding for the Department of Agriculture under the 2014 Farm Bill, so also known as the Agricultural Act. This is the bill that authorizes funds, appropriates funds for the Department of Agriculture. It's renewed periodically. This one lasts 5 years through 2018. And so you can see from this pie chart that 80% of USDA's budget is devoted to nutrition programs, food stamps mainly. And so on the right-hand side of the chart, you can see the other major categories of expenditure: 5% for commodity program support, 8% for crop insurance, and 6% for farm conservation programs. So just real brief, big picture background. The nutrition programs, as I said, SNAP, formerly known as food stamps, the Supplemental Nutrition Assistance Program for women, infant, and children, National School Lunch Program, Food Insecurity Nutrition Incentives, which provides money to subsidize purchase of fruits and vegetables by low-income people. And of course, administering all these programs costs a lot of money. It's not just the aid, but the administration too. Conservation programs, as I said a minute ago, take up about 6% of the USDA's budget. These include for farms the Conservation Reserve Program, the Environmental Quality Incentives Program, Agricultural Conservation Easement Program, all of which provide money or payments to farmers for being better stewards of farmland from the environmental perspective. The commodity programs don't make up as large a share of the USDA budget as they used to. The 2014 Farm Bill repealed direct payment, the average crop revenue election, and countercyclical payments, all of which were formerly relatively important sources of income for farmers, especially when the markets weren't particularly good. But those were unpopular for a variety of reasons, political. And so in place of these programs, the 2014 Farm Bill created two programs that are complementary to crop insurance. Price loss coverage pays farmers if crop prices drop below a reference level, and agricultural risk coverage pays farmers on the basis of their revenue if price and yield together drop below a certain level. So these are very similar to crop insurance, but farmers who undertake some conservation programs are eligible to opt into one of these programs without incurring any cost for themselves. But you can see the commodities that are involved in these programs, the farmers who are eligible for payments under these programs, they have to grow one of these grains, oilseeds, or legumes, and there aren't too many of those crops grown in Connecticut. So these two programs paid almost $500,000 to Connecticut farmers in 2015, the last year for which USDA has released complete data. It's not that important in our state. And instead of the commodity programs, subsidized crop insurance has become the main mechanism for improving farm revenues under the 2014 Farm Bill. By the way, I should say, as a professor, someone who gives lectures often, I really welcome your questions. Interrupt me anytime to ask you for any clarification, or if I need to repeat something as we start going through some arithmetic on what these crop insurance programs are all about. So the USDA subsidizes premiums for crop insurance, making it cheaper for farmers to take out insurance policies. But the subsidy is conditional on certain environmental practices. As I understand, they're pretty low bar, like not filling wetlands. Essentially, the subsidy can be revoked. And the specific policies available vary a lot by crop or species and by county and counties within states. So what's available in Iowa or North Carolina is very different from what's available here in Connecticut. And we have just a very limited menu of crop insurance policies available here. So Joe was talking about 10 minutes ago about the Risk Management Agency, which paid for this program today. They oversee the federal crop insurance program. And part of it is that they manage the Federal Crop Insurance Corporation, which approves all policies, modifications to insurance policies, and also sets rates using actuarial methods. And then approved insurance providers are licensed to sell crop insurance. And AIPs all sell identical policies. So the policies are through the Federal Crop Insurance Corporation, and the agents are selling you the Federal Crop Insurance Corporation's policies, which is, again, it's part of the Risk Management Agency. So traditional crop insurance, just to give a big picture overview before we get into the specific programs, it reimburses farmers when either quantity produced decreases because of some natural event. This is known as yield protection. So just your yields have gone down, and so you have to measure your yield per acre in bushels typically, and the insurance will pay you if your yield decrease is due to some natural event like a drought, flood, or other weather, or an insect or disease that affects the plants or animals. The other major category of crop insurance pays payments to farmers when revenue is too low. And the technical term for this is revenue protection harvest price exclusion. And I won't get into that name. It's not available here in Connecticut. But farmers in many states are able to insure their production in terms of revenue per acre. There are several other varieties of crop insurance available, and we'll talk about them now. So the actual production history is the type of yield protection that's available here in Connecticut. You can also get yield protection with a supplemental coverage option, and so I'll be talking about that in just a few minutes. There's a program available that doesn't pay on the basis of weather conditions or other natural events, but based on market conditions, and that's called the Livestock Gross Margin Program. There's a separate category of insurance available for nurseries. There are a couple of different commodities in Connecticut that are eligible for insurance using rainfall indexes. And last, the Whole Farm Revenue Protection Program is for diversified farms. So the actual production history policy, this is a type of yield protection policy, and it's available for all 8 Connecticut counties if you're growing apples, and it's only available for a few counties if you're growing grapes or peaches. And the grapes is new for 2018. So this is based on your farm's historical production, and the payments are based on both the yield shortfall and a price that you elect to receive as compensation for any lost yield. And so your premium, your rate that you pay for that insurance is going to vary based on your elected price, and also your yield coverage level. So if you're producing apples, grapes, or peaches, and again, it's grapes and peaches in just a few counties, grapes in Litchfield, New London, and Windham counties, peaches in Litchfield and Middlesex counties, and apples in all 8 counties. You get to choose the price at which your lost yield is going to be covered. So Federal Crop Insurance Corporation sets a price. It's called the projected price, and you get to select coverage at anywhere from 60 to 100% of FCIC's price. And then your yield coverage level, you also get to select that, and the premium is subsidized at a different rate depending on what your yield coverage level is. And we'll talk about the details of what this means in a minute. But first, how are your yields calculated? So it's based on your farm's yields, not on some kind of county level yields or average historical yields for other farms. It's based on your farm's historical yields. You have to use yields over a period of at least 4 up to 10 years to establish what your actual production history yield is. And this is your baseline production level. If you don't have, excuse me, I'm gonna have to drink some water while I talk.
One thing, John, I
Yeah.
just wanted to mention is that a couple of things, just to back up for a minute. The whole point of crop insurance was to get USDA away from things like blanket subsidy payments, as well as what they call ad hoc payments, like when there was a severe drought, Congress would allocate a certain amount of money for relief for farmers, that kind of thing. The idea is that it makes it a more systematic way, broadens the coverage, and also requires the farmer to have skin in the game by paying at least some portion of their own premiums. So the idea was to kind of formalize what was a more ad hoc process where the Congress would periodically allocate money in response to natural disasters in different parts of the country. Another thing is that a lot of the crop insurance topics are going to sound super complicated, but the bottom line is that your crop insurance agent, and Farm Credit does have a crop insurance division, but there are others as well. The crop insurance agent, it's their job to kind of navigate that and explain it and make it digestible. So don't feel like you need to know every nook and cranny of the programs.
Thanks, Chris. So this, I hope, will give you some sense of at least the general classes of options that are available for different types of operations. And I mean, talking about yield coverage level and premium subsidy rate, I hope the examples will help you understand it a little bit. But as Chris says, the agents are going to be, they're going to be explaining you the policy in order to sell you a policy, but they want to make sure that you understand it and all the details of all the different options you could consider. So, yeah, that's a conversation you could have with them at a later date. In order to establish the APH yield for the purpose of this yield protection policy, you need to have at least 4 consecutive years of yield data. And if you don't have records for one of those 4 years, or if the crop is new, then you can use RMA's so-called transition yields for the county to fill up those 4 years of data. And there's a penalty there also. So you can't just take advantage of, you can't it's disadvantageous to drop a record. Because there's a bit of a penalty built in. So, for example, I'll just give one example, I guess, since nobody's got an orchard in the room. Non-organic fresh peaches in Middlesex County, the average yields, according to RMA, have ranged from 105 to 128 bushels per acre over the last 4 years. And so, if you're missing data for 2 of those years within the last 4, you have to use RMA's, the numbers that RMA has for those years. So for example, let's say you're a grower in Middlesex County of non-organic peaches and you just have 2 years of yield data, 108 bushels this year and 105 bushels per acre last year. Then you'd put in RMA's transition yields or T yields for the intervening 2 years. Those are 116 bushels and 105 bushels, and then there's a penalty of 10%, and then your calculated actual production history is the average of these 4 numbers: 108, 105, 104, 95, and so your APH yield is 103 bushels, and you can insure up to 75% of that yield. So I'll walk through a couple of examples here. In the first one, you've lost all the crop. There was a freeze, and the buds couldn't form, and so you've lost all your peach crop. So the APH yield was 103 bushels. If you elected a coverage level of 65%, then multiply 65% times 103, you get 67 bushels per acre equivalent guaranteed. And let's say that you elected, and so if you've lost all of the crops, I know I maybe shouldn't stand so close, but if you've lost all the crop, your actual yield is 0, then your bushels per acre loss is going to be 67 bushels per acre. Multiply that by the maximum price that's established by FCIC, and you get an indemnity payment per acre of $3,400. So obviously that's not your profit, that's not accounting for the premium, but I left the discussion of premiums out of the presentation today. Looking at a slightly different example, if you have the same coverage level and the same price election, but let's say you have 60 bushels per acre yield instead of 0 bushels per acre yield, then you're eligible for a payment of 7 bushels per acre times the price that you elected, $51. Again, that's the maximum price for peaches in this county. And that'll give you an indemnity payment of $359 per acre. So I mean, again, it's okay if you don't have all the details, but if anybody wants me to go over this again, I'm happy to spend the time walking through this example again if somebody wants me to repeat anything. All right. So again, this is about covering lost yield due to natural causes. It's not about the farmer's bad decision making or failure to irrigate because they wanted to save money on irrigation water. This is about covering weather conditions or disease or fires, wildlife damage, all things that are naturally caused outside of the farmer's control. And here are the dates. I assume that the days of the year are going to be the same for 2018. But you need to make your purchase decision by November 20th. You need to report your previous year's production and acreage by January 15th. And then your premium isn't billed until the end of the crop year, August 15th. So the supplemental coverage option is an add-on to the yield protection policy. And again, in Connecticut, the yield protection policy is the actual production history policy. In other states, there are other types of yield protection available. The supplemental coverage option is only available for apples in Connecticut, but it is available for all 8 Connecticut counties. So again, you can insure the APH yield up to 85%, and the supplemental coverage option pays when the county level yield falls below 86%. You don't get to elect the price for your coverage under the supplemental coverage option. This is the Federal Crop Insurance Corporation's price, and this ranges depending on the type of apple and the production practice, whether you're irrigated or not, organic or not. 65% of the supplemental coverage option premium is subsidized. And so the way this works, again, the dates are the same. Okay, yeah, I changed the slideshow up a little bit. So let's say you have a Hartford County orchard with 10 acres of Honeycrisp apples, and your APH yield is 260 bushels an acre. So what I'm going to do in the next slide or two is just compare the outcomes from having an APH policy versus the supplemental coverage option, in addition to the APH policy. Supposing that you've purchased coverage at 75% of the APH yield and 100% of the FCIC price. So in example 1, your yield is 85% of normal. Because you elected to buy coverage at 75% of the APH yield, you won't get paid out of the APH policy with that yield level. However, if the county level yield is below normal, in this case it's 80% of normal, you're going to get paid under that policy. Under the SCO policy. So in this example, the county yield is 80%. You get the difference between 86% and 80%, or 6%, at the FCIC established price of $49.90. And this comes out to $778 an acre in this example. Example 2, your yield is worse than it was in the previous example. It's 70% of normal, 182 bushels an acre, whereas your normal yield was 260 bushels an acre. You purchased the APH policy, which guarantees you the equivalent of 75% yield, or 195 bushels an acre. So with 100% price coverage, you get $49.90 times 13 bushels an acre, or $848 an acre. And if you've also purchased the SCO YP policy, you're going to get the same 778 payment as in the previous slide, on top of the $848 an acre. So again, the supplemental coverage is based on the county level yield, not on the farm level yield. The livestock gross margin is different. As I said before, it's not based on weather, it's not based on natural disasters at all, and it's not based even on your farm's costs or revenues, but it's based on the market value of the product minus the feed cost. So this is considered the gross margin for livestock, as Rick was talking about earlier. This is the biggest margin that you get, and then you subtract out other costs of operation and overhead. But so the livestock gross margin is defined as the market value of the product minus feed costs. And payments are made based on futures prices for the meat and futures prices for the feed. And you can enroll in this every month of the year for up to 10 months for cattle and up to 5 months for swine. For dairy, there's a maximum coverage of 240,000 hundredweight per year. And the premium subsidy is only available if you elect to cover 2 or more months of production. So an example here is, let's say a dairy producer insures 1 month worth of production, 5,000 hundredweight, and then the premium is going to be based on the futures price of milk and the expected feed costs, and that's also based on the futures price of feed. The farmer is going to state what the feed mix is, and then the gross margin is going to be calculated based on those expectations. $18 a hundredweight minus $10 a hundredweight. He's guaranteed a margin of $8 per hundredweight. At the end of the day, the end of May, when his payment is made, Class 3 milk futures prices are $16 per hundredweight, and futures prices for his planned feed mix are $11 per hundredweight. Then his so-called actual gross margin is going to be $5 per hundredweight. It's not his actual margin because these are based on futures prices, but this is the way it's calculated. So the difference between the guarantee and the actual is going to be $3 per hundredweight for each of the 5,000 hundredweight he produces, or $15,000. That's how that works, and it works really similarly with swine, with pork. Nursery commodity insurance works a little bit differently. So this is about expected revenues, and it's based on an audit of the inventory. So as a nursery, you're eligible for this type of insurance if your operation makes at least half of its gross income from wholesale. There are certain restrictions on the ways that plants may be grown. You can't have a growing container that has 2 or more different cultivars or species. You can't insure Christmas trees. You can't insure plants that are either going to be used as stock or grown for harvest of buds, flowers, or greenery. Again, it's about protection from weather, natural events. So the nursery commodity insurance will cover between 50 and 75% of the plant inventory value. If you have $100,000 worth of plant inventory and you lose $40,000 worth, then the crop insurance indemnity will be the difference between what's left over after the loss, in this case $60,000, and your coverage level. So if you covered 50% of your $100,000 inventory, then the payment wouldn't kick in until you'd lost at least $50,000 worth, and then it would be the difference between your coverage level and what is left in your inventory. There's also catastrophic coverage available. So this is fixed at 27.5% of plant inventory value for nurseries. And this is available for a flat administrative fee of $300. So some examples here, if you lose 70% of your inventory and you have 30% left, you're not going to get any payment at all. You're going to have the $300 administrative fee or premium, but you're not going to get any payment, even though you've lost 70% of your inventory. If you lose 75% of that $100,000 inventory and you have $25,000 in inventory left, you're going to get a 2.5% indemnity payment, the difference between the 27.5% and the 25% threshold. If you lose it all, you get a 27.5% indemnity or $27,500. Since you all aren't actively working in nurseries, these dates don't matter too much for you. But this is an annual plan. Insurance period begins on June 1st. This is an interesting set of policies. So it pays producers, farmers, based on rainfall indexes. And so I made this graphic thinking that the seminar today was going to be in stores on campus, but we're actually in a different grid. So these are quarter-degree latitude and longitude grids, and a rainfall index is constructed. And if the rainfall index in your grid for a certain 2-month period that you select is below threshold, then you will get a payment. And this is for use by people who have pasture and hayland, and also in Connecticut for apiculture or beekeepers. So you get to select an index level between 70 and 90%. If the rainfall level falls below that threshold, you receive an indemnity payment. Again, it's for a 2-month interval, and you select the value of production that you want to insure. And it's obviously you can't insure more than what your hay or your pasture land is worth, but you get to insure up to a certain amount. Deadline to sign up every year is November 15th. And this is a little bit hard to see, but this is an example for, again, Horse Barn Hill on campus. The rainfall indexes for the last several years. You can see, if you've got good eyes, and you can see it on the printout. The last couple of years, more than half of the values have been below 90%, well more than half the values. And so if you had selected this rainfall index coverage during most of those 2-month periods, you would be eligible for a payment. But the last couple of months, we have had, the last 3 2-month periods, we've had more than, well, I guess this hasn't been updated in a few months. And it hasn't been below the threshold for a little while now. And again, it's available for apiculture also. And the payments are calculated in a different way, but they're triggered by the same rainfall index numbers. The last one, which is probably maybe the most important for Connecticut and for people in this room, is the Whole Farm Revenue Protection Program. So this is designed for diversified farms with up to $8.5 million in insured revenue, up to $17 million in total revenue. It's available throughout the country. And again, it's for loss of revenue due to natural causes, not due to operator error. What we mean by $8.5 million in insured revenue versus $17 million in total revenue is you get to choose your coverage level ranging from 50 to 85%. So if you have a $17 million operation, you're only allowed to insure up to $8.5 million. If you have a $10 million operation, you can insure at 85% and still get the $8.5 million coverage. Obviously, most farms in Connecticut who have diversified operations are well below this limit. But if you're in the $10 to $17 million range, then you're not going to be able to select the highest coverage level. The insurable revenue is based on your historical financial records, or if you can provide evidence of expanding, like you've added animals to the herd, or you've expanded the size of your fields or your greenhouses. It has to be a diversified operation. So you can't have more than $1 million in expected revenue from animals and animal products. You also can't have more than $1 million in annual revenue, expected revenue from greenhouse and nursery. And you have to have at least half your revenue from commodities that you grow, not from commodities you purchase for resale. So I guess I'm wrapping up right on time. Good record keeping is necessary for crop insurance because you need, in many cases, to demonstrate your record of production or your history of revenues, or for other policies, simply to demonstrate the basis for your claims. You're going to need to be able to keep records of planting, replanting, inputs, production, harvesting, and disposition of the insured crop. Again, really important, USDA subsidizes coverage, but the level of the subsidy depends on the options that you select. And in general, there are many options to consider, but for a quick summary, again, diversified farms, the best option is going to be whole farm revenue protection. If you have apples, you can insure with the yield protection policy known as actual production history. You can also get the supplemental coverage option. For peaches and grapes, you have the actual production history option also, but only in 2 or 3 counties. The nursery has its own insurance, which is based on expected revenue. Dairy and swine uses the livestock gross margin, which is again based on market conditions, not on local weather or events that are unique to your farm. But the pasture, rangeland, and forage rainfall insurance index may also be used by people who have livestock operations, and yeah, that's a rainfall index, so it is based on weather, and also for beekeepers, the rainfall index insurance is available. So that's a summary. Once we get these videos posted online, I'm going to be able to provide the PDF, which has the links to many sources for additional information on everything that I've talked about for the last half an hour. But these links, yeah, so those links will be there online.